everything so far. And as you can all hear, this session is being recorded. We still have people joining. I'll give it another moment before we get going on the panel. And I guess we're all used to this process now after a year and a half of Zoom meetings and conferences. Okay, so maybe I will now get started, and if anybody else is joining, they can do so while I'm burbling away a little bit. My name's Diane Coyle. I'm Professor of Public Policy at the University of Cambridge and a microeconomist. I'm looking at digital economics and competition policy and markets and so on. But it's a great pleasure to have been invited to chair this very distinguished panel today. And we've got three panelists. We have Beata Javorcik, David Andolfatto, and Ricardo Reis. And so the essay question we've set ourselves is macroeconomic policy and the outlook after the pandemic. And the plan is that we will have some discussion among the panel. We've talked a little bit about what to cover, and then we will turn to audience Q&A. So please do get your questions or comments ready and use the Q&A function to do so. Okay, so with that, let's get going. And I'm going to start with inflation, which is one of the hot topics of the day, obviously. And also start with Ricardo to kind of set the scene for us, Ricardo. Is inflation temporary, permanent? How do you see it panning out in different places? And what are the risks to the outlook?
So I think that let's start with the temporary. I think it was not hard to guess a few months ago, and I can say that with some confidence since I did guess it and went on the record, that one, we'd have a relatively swift recovery, even if an incomplete one, insofar as we just allow people to engage in markets again. And two, that because that happens not just incompletely, but especially in a differentiated way across sectors, that would come with a lot of relative price volatility. And the way we have to measure inflation, the prices we use, do not separate the relative price volatility perfectly from the more pure component of inflation. And thus we would end up with potentially very sharp spikes in inflation up as well as potentially down. So that's on the temporary permanent question. But I think the more interesting question, not that we'll have volatility on inflation, I thought that was easy to guess during 2020, is whether there will be higher inflation into 2022 and 2023 and going onwards. And here I think, Diane, let me separate the answer or the perspective between the US, because that's been so much in the news, and then the Eurozone. And of course, in the Q&A, you can force me to talk about the UK or other places. But when it comes to the US, I think there are three things that one sees clearly in the data. And by data, I mean looking at expected inflation as measured in market prices, as measured in surveys, as well as measured in models and forecasts based on fundamentals. First, that the risk of deflation, which had been potentially high, varying and important in the last decade, is pretty much fallen to zero. The option data on that speaks very loudly. Two, that the risk of an inflation disaster, which I'm going to define as, let's say, 4% average inflation in the 5-5 horizon, so between 2026 and 2031. I would say that's a disaster because that would be a lost inflation anchor and one that's persistently so. Only the 1970s in the US are a little worse than that. If you actually look on average for over 5 years, having inflation 4% over 4 years, basically only the 1970s, and then you have to go back to the 1920s to get anything close to it. Well, that probability went from essentially close to zero to now, according to the option prices, being around 10%. Not just the option price, by the way, but some heterogeneity in the surveys. Okay? Now, is 10, 15% something that makes me lose my sleep? If I was at the head of the Fed, yes, it might a little bit. But at the same time, it is not the median forecast or the most likely outcome. It is something that you should worry about and deal with. Thirdly, that when one looks at the surveys, and what is perhaps more distressing is that when one looks at the surveys of households, there is a very clear shift to the right, and especially an accumulation of mass, again, on the right tail, a share of households who think inflation can really get high. Now, that makes me quite a bit more nervous because you saw that once in US history, and that was in the period between 1967 and 1971. Now, that does not mean it is inevitable it will happen. It means that policy has to be ready to assert, in the case of the Fed, its inflation credentials. Because if one looks at the history of the Fed in that late 60s, I think it was not so much that the drift had happened, the anchor was getting lost. It was that policy through both Arthur Burns and Chesney Martin did not respond aggressively for political, ideological in the sense of model reasons that have been well documented in literature. So I think those are the real concerns. Now, very briefly, Diane, when we switch that to the Eurozone, the fact that the risk of deflation has not disappeared in the Eurozone, but has significantly fallen, and that's also true, is great news, because that risk was much higher in the Eurozone just 2 years ago than now. The fact that what about the inflation disaster on the right? The probabilities on that are still much smaller than the US, more like 5%. Again, partly because you start from a much lower level. And also the ECB has been much less bold, in my view, rightly so, than the Fed was 6 months ago. I think the Fed overstepped and created that inflation disaster probability they didn't have to. And thirdly, on the surveys, of which the data sadly in Europe is much worse, we do not see that potentially an anchor than before. So I'm quite unworried about inflation in the Eurozone. When it comes to the US, I think, one, there's this disaster that one has to monitor, and that has to do a lot with monetary fiscal interactions and fundamentals. And three, there's this responding to people by reasserting inflation credentials and not being and not making the mistakes of 1969, 1970.
Well, there's a lot to pick up there. Thank you, Ricardo. I'm going to start with the non-US parts of that and turn to Beata first to talk about all parts of Europe and what you see the inflation picture being, whether you agree with Ricardo or not about that.
Well, thank you very much, Diane, for the invitation to join this conversation. So let me take the perspective of emerging markets in the broadly defined European neighborhood. So there we have also been seeing an uptick in inflation driven by similar factors, so pent-up demand, higher commodity prices, currency depreciation. And different countries have been reacting in different way to this uptick in inflation. So at one end of the spectrum, we have Turkey. During the pandemic, Turkey has been running a very loose monetary policy. Credit has expanded significantly. That has resulted in positive growth of 1.8%. So Turkey was the only one other than China, the only other than China country among G20 that had positive growth last year. But of course, this growth came at the price of macroeconomic stability. Turkey was already running a double-digit inflation prior to the pandemic, but as of July, inflation reached 19% year on year. And so far, there has been no reaction from the interest rate side, so no reaction from the central bank. Now, at the other end of the spectrum, we have Russia. Russia had been pursuing very prudent, conservative macroeconomic policy. Russia also experienced an uptick in inflation in single digit, but already in July, Russia quite decisively increased interest rate by 1 percentage point. That is the largest increase in the past 7 years. So very different reactions. Even if you think about new EU member states, Poland and Hungary, both countries had the highest inflation in the EU. Both have very low unemployment. They have very hot labor markets with wages going up by 10% last year. And yet, Hungary had an increase in interest rate and Poland did not. Now, so what makes these countries in the region different when it comes to thinking about inflation? Well, first is the recent memory of hyperinflation. If you are over 50 and you are from the region, you remember the hyperinflation of the 1990s. Second is the much more recent history of independent central banks. These are fairly new institutions, and they had much less time to build up credibility, to build up reputation. And third, there is explicit or implicit political pressure to keep interest rates low. So the bottom line is that this combination of recent memory of hyperinflation may make people more sensitive when it comes to expecting high inflation in the future. And the central banks, which may find themselves under political pressure, may not act soon enough to prevent those inflationary expectations from entrenching themselves. Thank you.
Thanks, Beata. That's fascinating. And I hadn't actually thought about the very different institutional context. Let me turn now to David. And I guess you might want to comment on some of Ricardo's perspectives on US inflation, David.
Yes, let's see. I have some notes. Yeah, thank you, Diane. Again, I appreciate the opportunity to be here in this discussion. I wanted to focus my discussion on the U.S. economy, and from the perspective of a Fed official who is concerned with some of the challenges the Fed may be facing in fulfilling its congressional mandates in this post-pandemic world. So, yeah, I thought these were both very interesting points that were raised. Let me provide, I think, just a little bit of context here to just set up my perspective on this. I could begin actually with the financial crisis. We can argue whether or not that was something that was avoidable with policy. I happen to think it was, but I mean, conditional on it happening. I mean, how did monetary and fiscal policy conduct itself? As we know, the recovery was very slow. It took basically a decade for the prime age employment to population ratio to recover. But on the whole, I think that monetary policy, for the most part, was conducted in a pretty good manner. There were perhaps one or two times the FOMC, I think, got a little bit ahead of itself with its desire to kind of normalize things. But on the whole, I think that the slow recovery dynamic, for the most part, could be attributable to insufficient fiscal stimulus. Now, I think the evidence for this can also be seen by the fact that inflation remained below the Fed's 2% target for much of that time, when the policy rate was close to its effective lower bound. Now, the Fed has interpreted this low inflation episode as partly a monetary policy mistake, and the low and this is something that the new inflation framework, the average inflation targeting framework, is designed to address. I'm kind of my own view is that persistently low or high inflation and the low money market yields that go along with persistently low inflation have more to do with kind of supply and demand factors for U.S. Treasury securities, or kind of like the broader set of outside assets. And I think this is something that the Fed does not have very much control over. And so to the extent this is true, this will feed in particular to Ricardo's perspective on the ability of the Fed to rein in any inflationary pressure. Now, I know many people are skeptical of fiscal theories of the price level, but in virtually every economic model I know, fiscal anchor is necessary to pin down the long run rate of inflation. And monetary policy, specifically, I guess we should say interest rate policy, can, of course, influence the price level, among other things. So monetary policy can influence inflation dynamics, but it can only do so in quote, the short run. Interest rate policy alone cannot, in my view, determine the long run rate of inflation, at least not without appropriate fiscal support. So now, I know a number of people might be asking how I can think fiscal policy has very much to do with inflation, given how rapidly the debt has risen since the financial crisis, and again, since the COVID-19 crisis, all with little apparent pressure on long-run inflation expectations and long-term bond yields. But my own view is that we should keep in mind that any observed change in a quantity of an object may entail both supply and demand considerations. So, and I think for myself, I can easily point to several forces that have contributed to increases in the global demand for U.S. Treasury securities in recent decades. So, for example, the growing use of Treasury securities as collateral in repo and credit derivatives markets beginning in the 1970s and kind of accelerating through the 1980s. We saw the, again, a big increase in the demand for treasury securities among emerging economies, especially in the context of shortly after the financial crises of the 1990s. And then, of course, we had the evaporation of private label safe assets during the financial crisis, both in the United States and then in Europe. And that left a big gaping hole for treasury securities to fill. We had next, a very large increase in the regulatory demand for treasury securities, thanks to legislation like Dodd-Frank and banking reforms like Basel III. And then on top of that, we have like the Fed standing repo facility and the FEMA facility, which should further, I think, augment the demand for treasury securities. And if that's not enough, on top of all this, we've witnessed kind of this emergent class of money funds called stable coins that are further contributing to the demand for US Treasury securities. And so the point of me mentioning this is that the demand side has played a very important and fundamental secular force here in this story. And I think it would be wrong to just focus on the supply of this treasury debt. So these demand factors, the ones I described, are disinflationary in nature. And I believe that they are leading bond investors to revise down their expectation of the future path of policy interest rates. So, I mean, I think it's interesting to ponder a counterfactual here. I mean, in particular, let's think about what may have transpired absent an accommodating fiscal policy. I think we may very well have experienced kind of like the mother of all deflations, quite possibly. And so if this is correct, then an elevated debt to GDP ratio, given a relatively stable inflation and interest rate structure, kind of reflects more an elevated demand for real outside assets. So the problem is not that the debt to GDP ratio is going up. The problem is what disruptions might occur if it goes down, say because of a sudden and unexpected inflation. So now, and I think perhaps related to what Ricardo mentioned, the recent rise in inflation is concentrated in durable goods, and I think this is mostly attributable to the ongoing supply chain issues associated with the pandemic. I think this effect is likely to reverse itself, kind of the way lumber prices recently have, for example. But some of what I think is transitorily high inflation may not reverse itself, leading to a permanently higher price level. And this is what I think a lot of households and regular people are worried about. I mean, households are worrying that in this case, whether or not they were recipients of transfer income, which was actually pretty generous in the United States, households are worried whether their wages will keep up to the higher cost of living. Even if the inflation is transitory, the cost of living, the price level is higher. But then there's even the possibility, though I think less likely, although judging by the statistics Ricardo mentioned, perhaps a bit more likely than I thought, that the rate of inflation itself will remain elevated and that inflation expectations will rise above the Fed's 2% inflation target. This may happen, I think, if the traditional bipartisan support for fiscal anchoring kind of in this new generation of congressional representatives is perceived by people to start to wane, or for that matter, if the global demand for safe assets begins to slow. We can't rule either of these things out, I don't think. If either or both of these things happen and are persistent, then the Fed may find itself with what Sargent and Wallace have phrased an unpleasant monetarist arithmetic. Now, that paper, which was published exactly 40 years ago, warned how tightening monetary policy without fiscal support might actually make inflation go higher rather than lower. Now, the implications for US monetary policy, I think, are quite interesting should an event like that unfold. A determined Fed might try to inflation by raising its policy rate, the way I think Ricardo is recommending. The result is no question is likely to be disinflationary, and it'll likely come at a cost of a recession, the depth of which will depend on how rapidly and unexpectedly the Fed will have to raise rates. But now, think about a world where fiscal policy remains steadfast and unaltered. Then the logic provided by Sargent and Wallace implies that the inflation will eventually return, and moreover, it will return even higher than before because because the deficit's going to have to go up to finance an even higher interest expense on the debt. So interestingly, kind of the best thing that the Fed could do in such a situation is actually the opposite, is to actually kind of lower, or at least not raise the rate as high as it might otherwise do, but actually perhaps even lower its policy rate. And I don't know, I think perhaps as a practical matter, to save face, perhaps the Fed might want to announce a temporarily higher inflation target, and then kind of just cross your fingers and hope that the fiscal authority gets its house in order. The notion that a Volcker-like policy would lower the long run rate of inflation on its own, I think is not quite right. I think it would depend on some form of fiscal capitulation. And I think it's important to realize that this type of capitulation actually did happen to some extent under Volcker. Although keep in mind that in that era, Volcker also had considerable congressional support from both sides of the aisle. I mean, there were debates going on the pages of the Wall Street Journal between Volcker and Treasury Secretary Donald Reagan at the time. I mean, there was a lot of pressure, political pressure to do something about the deficits, notwithstanding the fact that they were up higher, elevated during the Reagan years. So I think I don't think that this type of political support is something we can count on, especially given today's political climate. So I think my recommendation is you might want to buckle up. We may be in for some interesting times ahead. Thank you.
What I find fascinating is how much emphasis in different ways you've each put on institutional factors, local pressures, the politics of how this will all play out. So I don't know if Beata or Ricardo, you want to respond to any of those points that David just made there?
I can follow up a little bit. I think David rightly pointed that, or let me elaborate with, but with a slightly different perspective to make the debate a little more interesting on what David said. It is true that there's a lot more demand for total government debt, or at least that one observes that a larger quantity of it is outstanding without any adverse, let's say, price reaction. And yet, if one looks at the composition of that debt, it is also the case that there's been a dramatic reduction in the duration of the privately held debt of treasuries. Okay, we've replaced 10-year treasuries for overnight reserves in terms of the consolidated public liabilities of the government, and there hasn't been really any kind of extension in the maturity of the new issuances. As a result, what that means is, and linking it back to the inflation points, inflating away the debt now, which is always quite hard and historically actually rarely happens, is extremely hard for the US today, in that any jump up of inflation that's significant, that's persistent in any way, would actually have a relatively limited impact on the real value of the debt, unless financial repression was imposed in order to extend this duration and maturity, which right now is very low. Second, and related, inflating the debt, or better even, if indeed we have a little bit of an inflation disaster override increasing the scale probabilities, that is potentially what would disturb the, let's say, benign equilibrium that David was referring to. Why? Because the fact that treasuries, there's been so much demand of it, and if one goes through the list of some of the reasons David listed very accurately and precisely, well, some of them rely on precisely the debt being safe. And one of the major sources of risk of debt is inflation and the risk premium that come with it. It is partly because inflation has essentially been a constant at 2% for 20 plus years in the US, that has made the treasuries be considered to be quite so safe by quite so many people. If there is a perception that inflation could be back, both as a level as well as a volatility, the increase in the inflation risk premium, which would happen, like they were saying, in any model where there were the change in fundamentals, would imply potentially a quite dramatic reduction in demand and thus trigger a fiscal crisis. So I think the link between inflation and debt, just to link a little bit to what I was saying, what David said, and complement them, is right now has many layers and some potentially interesting ones. And so I actually think that keeping inflation under control is, if anything, more important now for the Fed than ever, in part precisely for the fiscal reasons. Even though many institutions have been both pressured towards putting a bigger weight on the other leg of their dual mandate on account of just memory, as Beata was mentioning, of there's essentially very little memory of any cost of inflation, as well as legitimate desires to deal with problems such as inequality and climate change and others. At the same time, I do worry that inflation, if it were to come back, would quickly unravel the very benign equilibrium that David was describing in the last few minutes, and could be the trigger to the malevolent equilibrium that David as well was describing could happen in a fiscal dominant sense.
If I may jump in, just mention, if you look at emerging markets in this broadly defined European neighborhood, most of them have been able to borrow during the crisis. They had a lot of fiscal space. They were able to borrow cheaply. On average, interest rates went up by 0.5 percentage point. So the cost of borrowing went up by 0.5 percentage point, with a few exceptions. So if we look at the situation today, in most of these middle-income countries, that situation looks sustainable. But history teaches us that after crisis, we tend to be too optimistic about debt sustainability. And of course, an increase in global interest rates may invite more scrutiny of fundamentals. And then things may get interesting. Back to you.
Thanks, Beata. I mean, that takes some, let me say, first of all, to participants, if you have any questions, put them in the Q&A. There aren't any there yet, so we're going to carry on for a little while longer as a panel. But I'd like to pick up from that point, Beata, about how things might have changed after the crisis. And this isn't just macroeconomic policy, it's that the state has stepped into the economy in a big way. If we're not going to be able to inflate away the debt, which is the kind of the received wisdom about it, I suppose, in the media, what is going to happen with those debt burdens? And are we actually at a turning point where, after many decades of consensus perhaps about the role of the state, that has broken down, and we might see some change in public expectations about what governments can do? And so, Beata, maybe I can stick with you there. And have you observed changes in those economies?
Thank you. So the state already has been back with a vengeance after the financial crisis, and it has manifested itself in the increased presence of state-owned banks. If you look at assets of state-owned banks, or if you look at number of branches, their relative position relative to private banks has increased tremendously after the global financial crisis. And there is a positive and a negative side to it. On the bright side, state-owned banks have greater risk appetite. You see very clearly in the data that they are more willing to lend to young firms. They are willing to lend to firms without credit history. They were the ones who stepped in during the global financial crisis, and they were lending while private banks and foreign banks were curbing their lending activities. However, on the negative side, there is a literature documenting electoral cycles in lending by state-owned banks. As we documented in our last transition report at the EBRD, if you, for instance, look at Turkey, you see very clearly that prior to local elections, localities which were aligned with the central government were receiving a lot of credit. State-owned banks were pumping credit, while at the same time, they were withholding credit from localities in the hands of opposition. So that's the state-owned banks. Then let me mention state-owned enterprises. I think SOEs are going to emerge as winners from this crisis. If you look at the data, you again see that, for instance, during the global financial crisis, while private firms were laying off workers, SOEs were much less likely to do so. At the EBRD, we ran a survey of our countries of operations, of households in our countries of operations, and we noticed that Belarus had the lowest share of respondents reporting COVID-related job losses. That's not surprising because half of the employment is accounted by state-owned enterprises and a further quarter by public sector. So SOEs will do better simply because they can count on government support. And that has several implications. First of all, it has implications for government coffers. This support has to come from government budget, but it also has implications for long-term growth. If you analyze regulation that governs state-owned enterprises in emerging markets, the picture is quite ugly. In most countries, there is no regulation that would prevent state-owned enterprises from getting financial support that gives them an edge over private sector. So often they are entitled to concessionary tax rates, they are able to buy inputs at below market prices, they get subsidized credit. So there's a real risk that this expansion of SOEs is going to undermine the private sector that has already been battered by the crisis. And we know that SOEs tend to be less efficient, less innovative, so that means that long-term growth may be affected. Thank you.
So let me turn to Ricardo and then David with similar questions. What happens with the debt? Do we see austerity or a more present state? And I guess also, what about real growth prospects as a way out of this? So Ricardo, do you want to go first on that?
I thought it was David. Yeah, so I think, so on paying for the debt, I mean, austerity has become this ugly word. And so I'm not quite, it's a little bit like calling someone neoliberal. So I kind of avoid that word now. I just don't know what it means anymore. Are you going to have to raise taxes to pay for the debt? Yes. But will growth or output be so much higher that those higher taxes won't be as painful? Maybe yes as well. But yes, there are budget constraints in the government. There's no ferries flying around. There's no helicopters of resources that will magically appear from Mars. And so, yes, you will have to pay for this debt. I think it was in many ways good economic principles theory that when you have an emergency, you borrow from the future in order to deal with that emergency, and then you pay for it over a prolonged period of time. And during that time, you are under the risk of sovereign debt crisis, and you have to manage the public debt very carefully, and manage you will, and hopefully with some success and subject to the dangers that Beata mentioned. On the greater challenges, as you were mentioning, Diane, I think, there's two fundamental changes that at least have me speculating, not forecasting, because I got one right out of 10, and probably 9 wrong. I'm not going to even try to risk more, which is one, the fact that macro policy over the last 20 years has been about big disasters, the great financial crisis, the great pandemic, moving forward, perhaps the consequences of environmental climate-related large shocks and or social disruptions associated with inequality. That means that we are both living in a world where the great moderation holds in the sense of standard deviation of quarter-to-quarter changes in macro variables, but that infrequently we end up with some big disasters happening. That means that fiscal and monetary policymakers are more and more like what financial regulators of policymakers used to be, users of last resort, fiscalists of last resort, monitors of last resort, stimulators of last resort when these shocks happen, and less about managing the business cycle as was the reality of the previous quite a few decades. I think that is a different perspective on how policy is done. It's one that emphasizes, in terms of economic theory, this is an economic conference, more things like inequality, precautionary behaviors, importance of safety nets across different dimensions, consideration of right tails. And I think those are, at least I have changed the way in terms of which I look at macro questions more and more from the perspective of disaster prevention than the other. And second, and this one more related to Europe, I would not, and especially I think relevant to Europe, the very large role that tourism had has turned out to be a big determinant of different paces of recovery right now across European regions, has turned out to be a big source of risk. Tourism was usually seen, at least by myself, and you can all laugh at me for seeing it, as a fairly steady and nice source of revenue, with pros and cons in terms of its use of unskilled labor as opposed to other resources and others, but at least something steady. And we have now learned, and we should have learned when I remember the large impact that, say, terrorist attacks had on tourism to Paris a few years ago and others, how incredibly elastic and subject to shocks is the demand for tourism. And that implies that for many countries, the fragility that we associated with commodities, natural resources, and others may be something that arises now. That's something that I can't quite get my head around, but I hope among the audience, there's a lot of brilliant economists association that will think about this. But if I think in terms of service transformation, joined with my more disaster perspective, is how do I think now of tourism, which is a very big sector, when we tend to sometimes obsess about some sectors that aren't quite as big. But tourism is really, really very big in many countries in Europe. And it's much more volatile, much more elastic than I thought. And moreover, very complementary with this other big debate about working remotely, the ability to work across borders, linking to the way we organize our welfare states, labor laws, which are very national based and make it very hard to work in distance. And I think in Europe, where distances are small across nations, puts a big emphasis on also from a policy perspective, how to integrate better welfare states, labor laws, and others, and try to deal with this volatility. Thank you.
That's really interesting. I didn't expect tourism to come up in this session, I have to say. David, what about the US perspective on this, where from my side of the Atlantic, there looks to be quite a lot of polarization, not only between the parties, but within the parties on some of these questions? Yeah,
it's distressing to see. Very interesting to see how it works itself out. To keep you optimistic. I mean, Ricardo touched on a lot of issues. Let me just kind of raise a couple of points. One, Ricardo says there's no free lunch, that of course taxes are going to have to go up. Of course, we're going to have to go in austerity mode. I'm not so sure about that. And I think the United States is perhaps in a little bit of a privileged position, of course, if for no other reason that there's such a demand for its debt globally, both domestically and globally. And so who knows what the capacity is for the U.S. federal government to continue to finance its projects in this way. And I do think actually there's kind of growing bipartisan support to this idea. Is like, what? I mean, the debt, why should we worry? I mean, we saw this under the previous administration with the tax cuts, where we're seeing it under the current administration. And this is something very different than what was transpiring, historically. I mean, even during the Reagan deficits, there was very strong bipartisan support. There were the so-called blue dog Democrats, the very fiscally conservative Democrats that were putting a lot of pressure on the fiscal, side of things. And I think that fiscal anchoring may be vanishing to some extent, and it's to a large extent understandable, because what happened to all these disaster scenarios that people were talking about when you said the debt to GDP ratio was going to cross some threshold? So I don't know. I guess, but to put it in the language Ricardo might is thinking, is that perhaps there's a lot more kind of bond seigniorage capacity that the United States has, at least for the foreseeable future, that probably can forestall these austerity measures. But if I'm kind of curious to know Ricardo's perspective on this. I mean, he mentioned that the need to really keep inflation anchored in these times for precisely the reasons he mentioned, and that the Fed has to remain vigilant to maintain this inflation rate, because otherwise the whole demand for these securities might unravel. I kind of wonder what the feasibility of that is in the light of these forces that I've just described, this kind of waning of this resolve, or whatever you want to call it, about the need for fiscal anchoring. What is the feasibility of the Fed actually controlling inflation in that environment without the necessary fiscal support? And second, probably more pertinent too, is suppose we do believe that the Fed does have this power, and I actually do think it does, especially to control inflation in the short run and to manage inflation expectations. we have to keep in mind, in light of the polarization that you mentioned, that raising the interest rate for the Fed at this stage is going to elicit a great deal of political backlash. I mean, what we saw in the last expansion pre-COVID was that these policies were actually helping the less, the less fortunate, the lower income quintiles. It was really promoting earnings growth among disadvantaged group in the United States, and people saw that. People saw that. And the Fed was accommodating that and wasn't too concerned about inflation. It was letting these groups kind of catch up. To ask the Fed now to kind of raise rates, to create a recession, to slow down the progress that these groups are making, especially during the recovery during the pandemic. I mean, this is going to be tough, and understandably so. I just wonder, first on the actual feasibility, on the one hand economic, and then on the other politically. I don't know. I'm hopeful. I think that we'll get through these things. We've been through worse times before, but it certainly does make for some interesting times going forward.
Dan, can I interject just in 1 minute, just a comment, so to make this more of a dialogue? David, what you just said on the concerns about inequality, how it was important to raise votes. I've been recently reading about the 1960s US, and it was exactly what was being said in 1966, 67, 68. It was the time of the race riots, the Vietnam War. How could the Fed get on the way? You see exactly what Margie was saying. And that was the beginning of the inflation in the 70s. Now, of course, we can have a question of whether it was worth it and whether one wants to link the two. But I did want to make the observation that your words could have come out of what I was reading about 1968 just last night.
Well, that discussion is a really nice segue into the final segment here. We've got a very passive audience, so I'm going to call on Jan in a moment because I know he has a question, but otherwise we'll carry on. As I said right at the start, I'm not a macroeconomist. I think about structural changes in the economy, and we've just touched on inequalities, which had been getting worse in a number of economies over a long period and have been made worse by the pandemic, and they play out spatially as well, which affects votes. There's obviously a big change in generational attitudes going on. There are climate and biodiversity risks that financial markets are only just starting to pay enough attention to. And there are significant technical changes also continuing in digital, in biomedical technologies, in energy technologies, and also, David, you mentioned right at the start, crypto. So maybe I can go around of each of you in turn and just ask you to comment on one of these future trends and which you think is the most important, how it might affect the outlook. So let me start with you, Beata.
So in terms of large trends, I think climate policy is the next big thing. Climate policy is the next big macro shock that we will need to be thinking about, because to achieve net zero, we need to see an increase in carbon prices. And that's going to cause inflationary pressures, particularly in countries that are still very dependent on fossil fuels. So here I'm thinking of new EU member states such as Poland. That is going to hit very hard poorer households, and that will require government transfers to keep public support for European climate policy. In those countries, we also will need massive labor reallocation. So, Polish coal sector, heavy industry, these workers will need to move somewhere else. These industries are often geographically concentrated, so it's not very easy for workers to find alternative employment. So again, we will need government assistance, and that's also going to be costly. Some capital stock will become obsolete, and of course, we will need massive investment in adaptation to climate change, in R&D, in new technologies, in green activities, and many observers talk about sort of globally, we need an increase in investment on the order of 2% of GDP, sort of annually. So huge shock. But then let me focus on sort of smaller shocks and are more specific to, for instance, new EU member states. During the pandemic, digitalization has progressed. And actually, even if you go further east, if you look at countries like Uzbekistan, Tajikistan, where the share of population that has purchased on anything online is in single digits, even in those countries, you see firms moving their sales online. So there is this rapid digitalization. This is going to put older workers at a disadvantage. Many surveys, whether these are surveys of adult skills or surveys of who makes purchases online, clearly show that if you are over 50 and you are in emerging Europe, you are way behind your counterparts in advanced economies. And this is pushing these workers out of the labor force, which is something that may happen. It's going to be quite a negative phenomenon in countries which are facing already adverse demographic trends. And then finally, there is one of my favorite topic of women, right? We've talked a lot about how this pandemic and the recession affected women. We paid a lot of attention to women in services industries, to sort of less skilled women. But there was also an impact on skilled women. Job websites show that skilled women, professional women, have taken a step back. They are not updating profiles. They are less likely to apply for jobs, and that's not surprising given that women have picked up greater burden of homeschooling, that they are more likely to work at the kitchen table than in a dedicated office at home. And a lot of times this is a rational decision that is made at the household level. If the father makes more money, it's rational to prioritize the father's career. But the unintended consequence of this is that this is going to deepen the gender wage gap. So the pandemic may be perpetuating the gender wage gap. And we have so many priorities now. We want recovery, we want a green transition, that the gender agenda may simply be squeezed out. Thank you.
Thanks, Beata. David, I don't know if you want to pick up on digital currencies or if you have another favorite structural challenge that you'd like to talk about.
Yeah, I'll toss in some favorite structural challenges. Sure. I mean, a couple actually. One is, I guess, what a lot of people have remarked on is this kind of work from home phenomenon, kind of the breakdown. The physical proximity seems to be less important. It's still important. It's not going to go away. But just the whole concept of, what is an organization? What is a firm? How will it manifest itself? Do we necessarily have to be located as an organization at a physical location? So I think that phenomenon, which is playing out as we're all familiar with it, it's going to be interesting to see how that plays out. That's one thing. But the thing that I think is potentially likely to be more profound is kind of what I'm seeing happening out there in kind of the so-called DeFi space, kind of these, in particular, what people have labeled these decentralized autonomous organizations, or DAOs. These to me it's a fascinating concept where, essentially what these things are completely different ways of thinking about organizing activity, economic activity. It's just a completely different model of the way authority is delegated in an organization, however you want to define that, and what sort of protocols are involved in kind of governing these decisions, where there is actually no centralized authority. It's basically a much more decentralized model, and therefore kind of more democratic. You can see this. Bitcoin is a classic example of this. I mean, Bitcoin is a computer protocol that lives on, it's an open source code that just lives out there in the internet. There's no Bitcoin Incorporated. There's no CEO. There's no physical location. It literally lives on thousands and thousands of computers, if you want to think about it that way. We can criticize about the Bitcoin or kind of related cryptocurrencies all we want, but the point is kind of as a proof of work or proof of concept, I should say, is it kind of works. I mean, it is basically a ledger keeping or database management system that kind of operates without any delegated authority. It's just kind of a communal effort. Where the community now has expanded kind of globally thanks to the internet and kind of advances in other advances in computer storage, cryptography, and all these things. So I think, this is it's partly related to kind of what I mentioned earlier about stable coins. There is a class of stable coins that do use kind of conventional models to some extent, like the ones that we're familiar with. I mean, Facebook with Novi is going to come out very soon with its own DM project, but this is more of Facebook is a registered business. This is more along the lines of conventional money funds. There are classes of these stable coins that don't operate that way at all. For example, so that they just work very much like Bitcoin does, and the governance structures are very, very different. And to be honest, I'm not sure how it's going to play out. I mean, I think that it's very hard to forecast, kind of in much the same way in 1993, it was very difficult to forecast how the internet was going to play out in terms of how it disrupted organization. I think this is the stage we're at kind of with these decentralized autonomous organizations. It's kind of very fascinating, it's promising, it's exciting. It's also very scary in a way, because it's not clear how you can regulate these things. I mean, these things kind of live out there. I mean, it's like short of shutting down the internet, I don't know how one can necessarily regulate these objects. And of course, to a lot of people in the space, this is a feature, not a bug. but I think there are some reasons to be concerned. But that's where I keep my eye open in terms of kind of future developments. It's something that I think could profoundly affect the way we work and live.
Thanks, David. Ricardo, I will come back to you, but first I'm going to ask Jan to turn on his microphone and video, because I know he's got a question that he wants to bring in now. Jan.
I just wanted to ask David, talking about the digital currency. I know you've been writing a lot about central bank digital currency, which is not as decentralized because it would still be centralized, but there's a lot of advantages for it. Is it in the mandate of central banks to actually bring these out, because it's a way to also contribute to stability of the price system, and you can avoid bank runs if it works well and things like that. And are they dragging their feet because they're going to kill half of the banking sector and they're worried about that? Or they're waiting until China does it and then they'll react? What's your view on that?
Yeah, I mean, excellent questions. I guess I think the part of it depends on how you define central bank digital currency. And I think whether or not something like that is desirable might vary from jurisdiction to jurisdiction. Let me stick to the United States, I guess, or even Canada. So I define a central bank digital currency as just basically digital fiat currency. So this would be literally, say, accounts at the bank, or not necessarily the bank, by the way. It could be accounts at the Treasury. Treasury Direct does offer interest-bearing accounts for all U.S. persons already. So, I mean, it would be a short step to link that up to a payment rail, and voila, we have kind of a central bank digital currency. My question is why do we need it? I mean, at least at the retail level. Some people view central bank digital currency as accounts at the central bank that are managed by the central bank itself. My own view is it's probably not a good idea to delegate that responsibility to a central bank. That's not in their wheelhouse. Central banks are really, the culture is tailored to dealing at the wholesale level. But I could see a variation of central bank currency that is kind of makes sense. And that would be to open up the Fed's balance sheet, let's say, to a whole assortment of private service providers. For example, DM or Novi from Facebook, or PayPal, for example, or Square. I mean, why not open it up at the wholesale level? Because presently it's primarily depository institutions kind of have a monopoly here. They're the only ones that can create digital currency. Why not expand the set of agencies that are able to access the Fed directly? But this idea then kind of just boils down to a very old idea. The idea is to permit a narrow banking, to free entry into a regulated narrow banking system. So that idea, I think, has a lot of merit to promote kind of competition in this space. But whether it's necessary for a central bank to kind of, to do it itself, I mean, I guess you can make a case for kind of a basic service, no frills service, kind of as a basic public option. Something like that, though, I would recommend being delegated to the Mint or to the post office. I don't think you necessarily want the Fed to be involved in that. And so, yeah, that's kind of my view on it. I don't think it's critical. It might serve some purposes, but it's not as critical as I think a lot of people are making it out to be.
Thank you. So there's one question come in the chat about China and whether we think the changing role of China has implications, the kinds of things we've been talking about today. I don't know if any of our panelists want to pick up on that. I don't know that we have China experts on the panel. Ricardo.
As a Fed official, I'm not going to comment on China.
Well, maybe we leave that. Ricardo, I still need to come back to you on your favorite structural challenge. We've also only got 4 minutes left. So could you wrap into that, whether you're optimistic or pessimistic about the next 5 years, and if so, why? And then very quickly from David and Beata, optimistic or pessimistic, but Ricardo first.
Let me be brief. I already mentioned one thing that I'd like us as economists to, since it's an audience of economists, to think more about, and I told you tourism, and you were a little surprised, but I think that is important. Let me also, in terms of shocks, as I talked about large shocks, I would highlight things that we should work more on, think more on, and all the people in this great conference, is political shocks in the sense of with such a large government taking on so many roles and has grown so much in the last 13 years, going back to something you said, Diane, 40 minutes ago, the scope for governments to mess things around in good and bad ways is much higher. And as I look at the challenges that I learned in the last few days and that I will learn in this conference, I see those political shocks coming up everywhere. Yesterday, I heard our president, Silvana Tenreiro, talk about climate and how, and Beata's already mentioned this a little bit as well, how so much of it is really a political choice insofar as so many climate policies really hurt the poorer in society, and thus the extent to which we trade off the current poor versus our future generations. And that is a deep political debate where you can see very different options being made and some of them in unexpected consequences. I also learned yesterday from our other president, Penny Goldberg, about the international global system, and that goes to the China. Penny, giving expertise, talked about the change in trade relations and world domestic demand. I would emphasize the complete change in international financial architecture, how now it's a mix of IMF, regional financial agreements, and central bank swap lines, each of roughly the same size, and how combined with the push towards, let's say, nationalism, that it leads to a very different financial architecture that could again be the source of very large shocks. Third, tomorrow I will learn from Thomas Piketty in one of our guest conferences about inequality. And I think, again, a main concern for inequality is the extent to which it motivates in the old efficiency equity trade-offs policies that can be highly damaging to the size of the pie as we neglected the division of that pie changed. And finally, and now talking about not this Congress, but the next meeting of the European Economic Association in January, where one of the lecturers, I forget the FBVA or something, the BBV, I don't know, sorry, the lecture in January, which was given by Jan Heckhout, who spoke just a little while ago, and he has done so much work, and I'm very much looking forward to learning from him more about imperfect competition, how we're going to deal with the large digital giants and others, and how, again, it's going to be a political shock of either breaking them or letting them be, but it's going to be a difficult political decision with many trade-offs. And I think those we're going to have, going into the title of our session and your question, Diane, macro implications of this pandemic, macro implications of what will come up in the next 5 years. Thank you.
Yeah, and I do commend to everybody who's not read it yet, Jan's book on exactly these questions. Really great read. So one last word from each of you, optimistic or pessimistic? Ricardo.
Always optimistic. Challenge means changes and better things being done.
Certainly a good time to be an economist. Beata?
Optimistic, because I think the net zero transition can provide an external anchor for reforms in many countries and can guide investment, can guide reforms, and can bring growth.
And David.
Yeah, I'm optimistic as well, but I don't think we can take our eyes off the ball. Leaders have to really push here. We need a lot more sober thinking and with greater conviction. And I'm optimistic that that's going to be show itself somehow. But by and large, I think I'm optimistic as well. Thank you.
Well, it's great to see that consensus among the panel. David, I think you said earlier, I'm not sure how it's going to play out, but it's going to be a bumpy ride. That seems to be a good summing up of the discussion we've had. So thank you to David Andolfatto, Beata Javorcik, and Ricardo Reis, to Jan and Araya for the questions, to everybody for listening. And I hope you've enjoyed this conversation and also enjoy the rest of the day and all the other great sessions. Thanks very much, everybody. Bye from Cambridge.
Thank you very much. Bye-bye.
Bye.